Everyone wants that magic formula for investing, the foolproof asset that never fails. But let's be real. Does such an asset even exist? Gold, a hedge, but no cash flow. Real estate, solid, but literally illiquid. Crypto, exciting, but volatile. Stocks, rewarding, but risky if we choose wrong. So, what comes closest? And if we do acquire such an asset, when do we exit it?
This topic is part of the strategy and product knowledge domain of financial flywheel through capital mastery. The closest asset to foolproof investing is a sector-diversified ETF in a transparent governance economy, where investor rights are protected and corporate governance is strong. This might be the most resilient long-term answer we have. This is not a get-rich-quick scheme, but a way to build scalar wealth by owning slices of the best companies across sectors that keep changing and evolving with time. Okay, but first, what is an ETF? Here is a simple analogy. Imagine you walk into a restaurant and you have two choices. Order a la carte a single dish, like buying a single stock, and if the dish is bad, you're stuck. Or go for a buffet, where you get a little bit of everything. Say the rice, curry, starter, salad, dessert, dosa. Even if you don't like one or two items, the rest of the buffet will make it. That buffet is exactly what an ETF is. Think of the Nifty Index ETF as a simple wrapper around India's top 50 companies. The Nifty 50 index itself is built on free float market capitalization. That means companies are weighted based on the value of shares actually available to the public, not just total shares outstanding. Bigger companies like Reliance or HDFC Bank naturally carry more weight in the index, while the smaller ones like NTPC or Cipla carry less. Now the Nifty, like for instance the Nifty Bs, takes this exact index and mirrors it. Every rupee that we invest is split across 50 companies in the same proportion as the index. We don't have to pick winners. We don't have to rebalance. The ETF does it automatically whenever the index changes. So if one company falls out, like Satyam once did, and another rises in, like Tech Mahindra, the ETF updates itself. In just one trade, you can own a slice of India's economy. Imagine the IT, energy, FMCG, automobiles, healthcare, financials. It's a low-cost, transparent, and designed to grow as the market grows. That's the beauty of a Nifty Index ETF or any ETF that is sector-wise diversified for that matter. It's not just a fund, it's the economy that works in your portfolio. Let's discuss with a case study of what happened in Nifty Index in the mid-2000s. It was in the mid-2000s that Satyam Computers was a rising star in the India's IT sector. It was one of the crown jewels of Nifty 50, symbolizing India's booming tech story. Investors trusted it, institutions owned it, and it represented the promise of modern India. But in Jan 2009, everything changed. A shocking confession of corporate fraud, close to about 7,000 crores of inflated profits, brought the entire empire crashing down. Overnight, Satyam stock collapsed by nearly 80%. Investors who held only Satyam, it was a devastation. A dream turned into dust. Yet, for those who invested through the Nifty ETF, the story was different, because while Satyam exited in disgrace, the index didn't pause, it adapted. Rising from the ashes, Tech Mahindra stepped in as a replacement. It brought with it new strength, new governments, and new opportunities. Today, Tech Mahindra is a respected global IT services company. This is the proof that index, like the economy itself, renews and rebuilds. This is the power of diversification. A single company may fall, but the index endures. With a diversified ETF, you don't bet on one hero, you own the entire cast. And when one falters, another takes its place. A transparent governance economy is like a restaurant with open kitchen and clear bills. You know what you're getting. An opaque governance economy is like a canteen where the menu changes without warning. An opaque governance can thus take away a top-performing stock from access of non-citizens or deem it nationalized, thereby affecting the portfolio irreversibly. What matters is not what kind of political practice is followed in the region where the companies are established. It's whether the system is transparent, predictable, and investor friendly. So, when to exit a sector diversified ETFs? The question often asked is, when do you exit a sector diversified ETF even though it is bought in a rules based transparent market? Let's think about what you truly own. Not just stocks on a screen. You own a piece of the finest industries: banks, IT giants, energy leaders, FMCG powerhouses, healthcare innovators. Companies where millions of employees wake up every day to compete, to innovate, to build the goods and services that drive the economy forward. As these companies fight to stay on top, they push productivity, technology, and growth higher and higher in the battle. This compounds shareholder wealth silently in the background. You don't need to pick winners. You don't need to guess which company will survive. The index will do that for you. When one falters, another rises to take its place. So, when should you exit? The real answer is you don't. A diversified ETF in a transparent system is not a short-term trade. It is not a single lifetime trade either. It is an heirloom of wealth designed to be held, nurtured, and passed down for generations. Because markets may change, leaders may change, industries may change, but the pursuit of excellence never stops. And as long as human ambition drives these companies forward, your ETF becomes a source of scalar wealth, an asset in the broader flywheel design.